So Daniel Schreiber tweeted out this long thread today about synthetic agents, along with a long blog post. I want to talk about what this means, try and explain it and break it down a little bit further, explain why it's important, and explain why Lemonade is even doing any of this. So let's dive into it. So why does Lemonade have this problem to begin with? Well, I had this exchange via DM, a little bit of conversation back and forth with Damian Van Der Elst. I'm probably butchering your name. Awesome guy. I've had some good chats with him. Great Lemonade follow on Twitter if you want to follow him there. Anyways, he sent me this message a while back in May, I guess it was. He said, as Elon has mentioned a few times, the best reason to short Tesla was that without an existing fleet, service is loss-making because each car is in warranty and there are no out-of-warranty cars to sell parts to at high margin. Surviving until you have a seasoned fleet is hard. Lemonade has a similar problem in my opinion. They need old customers who have higher premiums and lower loss ratios. The fact that they pay the high customer acquisition costs up front hinders their ability to grow. The way to solve this, in my opinion, is by using your customers as brokers. In other words, a referral program. That way you can spread CAC throughout time. As Daniel explains in his blog post, the main reason other insurers typically have used agents to sell and distribute their insurance products is because those agents don't actually cost the insurer anything up front. The agents bear all that cost. So they're spending the cost, they're taking the risk, but then as those agents win over customers and sell customers, for the lifetime of the customer, they take a cut from that customer. That's how the typical model. But for the insurance company, it works because they don't need so much capital up front to grow those pools of customers to a decent side and to go through poor customers to get better customers that are going to hang around for a lifetime and pay premiums with very little risk. So it's a difficult problem. It's sort of an inertia problem. If you had just enough capital and it just spend it without fear, you could essentially just blast your way through to profitability, which is kind of the way Lemonade has been approaching it. And this company called General Catalyst, I never actually heard of, but General Catalyst has come along and is actually, I guess, an early investor in Lemonade. I think I read they have something like a 1% stake, if that's correct. Not sure, but I read that somewhere. General Catalyst, their idea is that for these sort of specific more software as a service companies, say you're selling a video game and you have to spend ad revenue to acquire a customer who gets your video game or your video game that's on a phone, and then the person who plays that game, maybe over a long span of time, enough people playing that game spend money on little bonuses or upgrades in the game. So you spend a higher cost up front, and then there's a long tail of profits that come back to you as the game developer. Same problem that Lemonade has, exact same problem, is they're more of this software company that is spending money up front, larger amounts of acquisition, sales, and marketing costs to get a customer, and then over a long span of time, that customer is paying them back, and some of them customers might even make claims in the insurance industry and become really costly customers. But if at a big enough scale with enough customers, in theory, you should make money on each cohort of customers as that sort of long tail progresses. But General Catalyst sees this as a good opportunity and a way to structure their own investments and say to these people that have companies like Lemonade to have this problem, they can come alongside them and say, hey, we're going to give you money for sales and marketing and customer acquisition up front. So we're going to provide you that capital, and then we'll get paid back over the next 2-3 years, in Lemonade's case, 2-3 years on the capital we spent, plus in Lemonade's case, a 16% return on the money they spent for the sales and marketing. But then they also mention the part of the risk that General Catalyst is taking is that on the flip side, if the sales and marketing spend does not pan out as expected, so somehow you get a cohort of really bad customers and they all fail and you don't even get your money back for acquiring those customers, then General Catalyst owns the downside. They only get paid if and when the company gets paid. So that's why it's worth at least, it's not just a typical loan that would be a lower interest rate, but they're getting 16%. And that 16% again is over. I see some bears sort of making fun of this deal, saying it's a 16% debt deal and Lemonade only has a 16% interest rate. That's all they can get. But that's not true. I mean, it's 16% but General Catalyst is taking part of the risk, or actually all of the risk, for acquiring those customers. And the 16% is not an annual amount, it's a 16% fixed amount for that, for what General Catalyst is doing, and that's over maybe a 2 to 3 year span. So 16% over 2 to 3 years is going to be a lot less than 16% each year. And Lemonade said in their blog that the lifetime value of a customer versus the customer acquisition cost is about 3 or greater. Actually, they say greater than 3, so this is actually good for my own modeling because I have it modeled higher than 3. So this is available to my Patreon members. I'm a little bit behind in updating this. I want to update this and comb through it again. But I did this at one time where a bit of crazy math here, where I looked at the churn rate of each cohort in time and how that cohort's churn might be declining, or that customer base of customers might be churning over time. And basically made these projection curves. I had made these curves, which were slowly getting better and better and better as the quarters went on, were higher, so there's less churn overall. But I projected these out, and then, which basically shows, hey, for any given cohort over a certain span of time, maybe even 40 quarters or 10 years time, at this point in time, maybe there's only 2% of the customers remaining 10 years in the future. But then on a later cohort, maybe it's 6% or 8% of those customers are remaining. That makes a huge difference in the total lifetime value, because what I did, you could kind of think of this as all the area under each curve gets you kind of the lifetime value of the customers inside of that cohort. So as the cohorts move up and up and up, as things get better and better and better, all the at Lemonade, and customers stick around longer, then the area under that curve becomes more and more significant. And also the customers, their premiums are getting better and better because the premium per customer is rising as there's more products available in more places. So the unit economics of this are really it's really interesting, and are exponentially improving. So but I had calculated a sort of an LTV to customer acquisition cost then from these projections, and it was about close to 2.5, 2.8. This was in Q2 of last year, and then Q3, Q4 of last year was actually about 4.3. 4.3 was where I was at. So Lemonade is saying they are greater than 3. So I think it might be in the ballpark, but maybe some of my projections could be a tiny bit too optimistic. But still, I'm just pointing this out to say I think this 3 number actually makes sense when I did this math. And again, this is available to my Patreon supporters if you want to join that and get exclusive content. But this ratio of greater than 3 basically means, of course, if they spend a dollar on sales and marketing, customer acquisition, they're going to get eventually $3 in gross profit back from that dollar. But it takes them about 24 months just to earn back the initial customer acquisition. So if they spend $1 or they spend $1 million on marketing and get a whole pile of customers for a certain cohort, that it would take them, for that dollar they spent there, it takes about 2 years before they get enough gross profit back, that $1 in gross profit back. And then over the rest of the years, if we flip back to this curve here for illustration, so for the first 2 years, you have this big area underneath the curve, and then as you descend down along that curve, it gets less and less and less. You're eventually, the rest of that triangle or area under the curve is going to be your other maybe $2 that you get for that ratio of 3 to 1. So you get the first dollar back, you spend $1 to get a customer, and then after 2 years you get that dollar back, and then after maybe, who knows, maybe it takes a long time, you slowly have this cohort that's diminishing but still profitable, you get another $2 back for a 3 to 1 return. But it's a huge problem because you're spending all this money up front, and it still takes 2 years just to get that initial money back. So again, that's that inertia problem we're talking about. That's the problem that Daniel's really highlighting here, is cash flow gap. So I think you guys understand kind of the problem that's at hand, and also the rough solution that General Catalyst can propose to them here. Let's look at a few more of the details. So our synthetic agents will finance up to 80% of our customer acquisition spend. So 20% they'll be spending just on their own in any given month. or up to, it could be less than that, but up to that amount, any given month, synthetic agents spend, and will receive a commission up to 16% from and only from the premiums paid by the corresponding cohort. That is all the people who join Lemonade that month. And after about 2 to 3 years, a stream of synthetic commissions from one cohort will tally to the synthetic agent spend on that cohort plus a fixed return, 16%. Once that cap is reached, commissions from that cohort terminate, and 100% of their premiums thereon out accrue exclusively to the benefit of Lemonade. Of course, if the stream of commissions peters out before the synthetic agents recover, that will be their loss only. Here's a super quick example to try and help break it down. So say they spend, as part of this 80% customer acquisition, GC spends, let's say $220 to get a customer, or maybe it's $220 times by 1,000 customers, etc. for that pool of customers, whatever it is on a per. You have to imagine it's a huge pool, but we're looking at the unit economics for one customer in that pool. So $220. And the customers say they have $1,000 annual insurance for a car. And then so they spend $1,000 in premiums, the customer. So GC gets $160 the first year, and then another $95 in the second year to get about $255, or a 1.16x the initial estimate, or initial investment, I should say. So that's kind of a quick and dirty example. Of course, the average customer that Lemonade is spending around maybe $200 to acquire, so it might be around that range, but their premium per customer is not at $1,000 yet. Eventually, maybe it could get there. So that's why it's going to take more like 2 to 3 years if this is a lesser number for the average customer. Some customers are going to, part of a cohort would essentially get you to your investment faster, but some are going to slow it down, and would have a slower average of maybe 2 to 3 years before they would get there. And Lemonade, again, their advantage is they don't have to spend a dime. That $220, that just disappears, and they're only spending a little bit more later on, but then those customers should become also more profitable for them by that time. And two of the big examples of this arrangement for Lemonade is that the relationship still is directly, entirely, exclusively with Lemonade. So advantage of that is, this isn't some other marketer that's coming in and trying to now tag on and market the right customers. No, Lemonade can target who they feel. They're entirely in control. They're entirely still the owners of this, and the owners of the customers they're getting. They're entirely vertically integrated, and they can say, hey, these are the customers. They live in this area and have this sort of behavior and use the app in this way. These are the ones we really want, and still target those exact sort of people with their marketing. They just now have fuel to spend the marketing dollars that's provided by GC in this arrangement as part of the up to 80% spend. And then the second advantage is they're not a partner for the life of the customer. So they only get paid out that commission over the next 2 to 3 years as expected. And then entirely the rest of the customers' lives. So you look back at that retention curve. So maybe by quarter 8, 6, 7, 8, we're about here. So this part of the triangle, if you imagine under each cohort's curve, part of that is given away as the acquisition costs for that cohort, but then the rest of the time, Lemonade captures all of the rest of the profits. And Lemonade doesn't have to pay for these cohorts. They don't have to pay right here at quarter number 0 or quarter 1. They can pay over those first 2 to 3 years' time. But I think it's a really big deal, and this is why, Daniel's pretty excited. In his blog post, he's saying they're really something of a game changer for Lemonade. We can accelerate growth without drawing down our capital reserves or selling more equity, and we can generate a significantly larger business far sooner with more cash in the bank with a materially higher return on capital. That's a lot, in fact. Thanks to our synthetic agents, we estimate our IRR on our CAC spend will jump to 90%. But it's a really big deal. I want to walk through another point here. We're chatting in the Lemonade community. There's a Lemonade community on Twitter. If you're not a part of it, you should go find it and join it. And one of the things they said was, we were talking about how many sort of customers this could result in. And I was doing a little bit of thinking on that because one of the other pieces of information here is that GC plans to give $150 million over 18-month period. And so if you imagine, though, say I use a customer acquisition cost of $200 per customer, which if you look at my model, the customer acquisition cost average over the last, let's say 9 quarters, it's about $205 per customer. So this is some really rough math, but about $200 per customer. And I assume, say, 30% churn over 18 months because last quarter, Lemonade's customer churn was about 21% for a 12-month period. So that means every 12 months, 21% of customers would churn. And my customer acquisition cost is lower than if you just put in the net change in customers divided by sales and marketing. It would be a higher number. That's because I actually account for the churned customers that you're also burning through. So that's why it's a lower number, but then you're losing customers. So anyways, I was just thinking through a little bit of that. Say you lose 30% and it's $200 per customer over 18 months. Then say for a $150 million investment, gives about 525,000 net new customers for that. Anyways, I need to do some updating on my model. I'm going to be away traveling. It's Canada Day weekend here in Canada this weekend, so sort of limited internet connection, and we'll be enjoying the weekend. But next week I will be updating this model and looking through this. How this sort of affects my model. This model is available to my Patreon supporters. So again, if you want to see that and see the updates in full detail, feel free to support the channel. And one more thing I wanted to mention was the main kind of bear argument I'm seeing around this is that, hey, you guys, it's really just a fancy way of saying we raise venture debt at 16%, but don't want to call it that. So we wrote 2,500 words about it, why we're calling it something else. People are basically saying, hey, Lemonade, you just took a loan to get more customer acquisition and you're paying 16% interest on it. Well, I mentioned earlier in the video, I don't think it's true that's really 16% because it's 16% over a 2 or 3 year span, but also I don't see how it's like debt because GC is retaining some of the risk. So say for 1 month, they get a certain number of customers and those customers in that 1 month cohort peter out and they don't actually get their return on it, then that's quite different than if you just had taken a loan. Whoever gave you that loan is not going to be retaining that same level of risk. Anyways, I hope all of this helped explain the synthetic agents a little bit better, and let me know what you think in the comments down below. Love to hear your feedback. Remember, it's in the bag.